what it appears to me at the end of that discussion is that the monetary policy apparatus lacks transmission mechanism from policy to effect. Okay, that is to say, there's a limited number of tools that are available to the Fed, and the Fed is incapable, not by cause, but by effect of the system, to prevent it from putting money down into the economy where it has to work in order to generate the demand, which is what you're trying to do. And so my question really is, at some point, don't you go back to looking at the system and saying there's something wrong with this system when we are incapable of using all the tools that we have, and still we cannot generate demand in the economy? And take a look at what other alternatives might be available for generating demand in the economy in different monetary policy initiatives, not coming from the Fed, really from the government.
So, these are good questions that we struggle with on an ongoing basis. There's certainly a lot of questions that we ask ourselves on an ongoing basis about the efficacy of what we're doing. I would say that, given the situation we're in, my outlook for inflation is it's going to be running below target over the next 2 years, and that my outlook for unemployment is it's going to remain elevated over that same time frame. What I'd like to be able to do is cut interest rates, right? And we can't do that at this stage. So we're substituting for that through alternatives, through the forward guidance that we're offering in terms of what's going to happen to the Fed funds rate, and also through our purchases. Now, if you looked at the effectiveness of those policies, and they are having an impact on the economy. I think if you look at what's went on in the mortgage market after the announcement of the flow of purchases that we started in September, I think the Boston Fed has done a lot of good work. You heard from the president of the Federal Reserve Bank of Boston yesterday. Done a lot of good work documenting how those effects are being felt in mortgage markets. We've done a lot of work on how the purchases of assets are showing up in terms of the pushing down not just the yields of those instruments, but actually yields across the economy. So I think that there is evidence that our actions are being effective. What I'm pointing to is actually that it would be nice if we did even more, I think, than along those lines, because I think our tools have been effective. Would it be desirable to have other actions being taken by other branches of government? I mean, that they have to face their own cost-benefit calculations. Some of my colleagues have spoken pretty openly about their desire for different policies. For myself, I don't try to think about their cost-benefit problem because it's not mine. I think about what I have to do, and I come to the conclusion, as I suggested, and I've suggested in speeches throughout this year, that we could be doing more than we're doing to help out the economy.
I just want to follow up on Joe's comment over here, because I want to be a little more direct. Can't the Fed use its bully pulpit, perhaps, and advocate something like what Lincoln did to produce greenbacks debt-free from the government directly into the economy for whatever programs, for example, FDR style, like a civilian conservation corps or something that might create the jobs that we desperately need? The economy is so far below capacity, and everybody knows that, and you've been saying it's going to be like that for a long time, no matter what the Fed is able to do, that we do need to look at other solutions. And the Fed does have the respect of all the economists in the world, and they are the leading economists, so they could certainly influence fiscal decisions. In addition to that, you mentioned that the land value was not predictable, that it would not crash like that. Is it possible to put, again, using your bully pulpit, to advocate for some kind of a land value tax so that these extremes of booms and busts do not occur, because the tax would take away the speculative power to make them occur? Thank you. So
I'll say a couple things in response to that. I said I'm speaking for myself and not for other participants of the FOMC. So here, this is really very personal. I'm going to say that I'm very you know, we've been given, I think, extraordinary latitude by Congress to make the decisions that we make as an independent agency. I think part of that latitude relies on our not pushing our bully pulpit too far into matters that are not our direct concern. So I myself, and you know, as again, I'm not speaking for everybody on the committee by any means when I say this, I feel very leery about. I'm very happy to talk about monetary policy, what the situation is with monetary policy, what we should be doing, what we shouldn't be doing. You know, that's my job. That's what. That independence, I think, comes with a sense of respect for the fact that these are other matters that are outside of our control. We shouldn't necessarily be commenting on them as. Now, with that said, on the fiscal side, you know, a number of my colleagues and Chairman Bernanke have, I think, been pretty direct about what would be desirable along those lines.
My question actually follows up on the earlier questions. What's the evidence that low real interest rates without proactive fiscal policies helps reach your mandate of maximum employment and price stability?
So you know, this is evidence that's based on a huge number of years of macroeconomic work that low interest rates provide stimulus to demand. Demand's what's needed. I mean, we heard someone assert that that's the most obvious. That's an obvious problem. That demand is what is needed, and by keeping interest rates low, real interest rates low, that's going to lead people to substitute towards spending as opposed to saving in financial market instruments and people and businesses. Now, you know, I think what's confusing for people right now is that there's a lot of evidence, I think, that real interest rates are not as low as they should be. And that makes people think, boy, that channel is not working at all. The counterfactual you should be thinking to yourself is, suppose the Fed had real interest rates at 2.5%, had been taking actions so as to promulgate a real interest rate of 2.5%. What would unemployment be then? What would inflation be looking like? I submit that we'd be falling even further short of our dual mandate on those cases. So in terms of the direct effect of, I mentioned this earlier, we've been, especially, I actually think on the interest rate front, on the forward guidance front, we have again, speaking for myself, I have a lot of confidence in that tool because it's pretty much business as usual for monetary policy. That is, we're always trying to communicate what's the path of our short-term decisions going to be in order to influence current decision making. Quantitative easing, I think, is more controversial, but you know, we've just done a lot of work about does the effect in those particular markets, when we buy mortgage-backed securities, when we buy long-term treasuries, how does that flow through into the economy into lower rates, and then how are people responding to that? And as I suggested, I think in the housing market in particular, I think you've certainly seen direct effects of that kind of stimulus.
One more follow-up on this general line of questioning. Your last point is the key one. That is, eventually this stuff percolates down to the consumer level, the borrower level, the household level. Where is the Fed's concern? What is the Fed doing that are clearly within its existing powers, especially in supervision and the new Consumer Financial Protection Board, to make sure that as you spray trillions of dollars of excess reserves into the banking system at one end, it translates into radically lower credit card interest rates, radically lower overdraft fees, more accurately reflecting the real cost to the bank of tolerating an overdraft, et cetera. A whole host of things about the financial and credit scoring. That's in Minnesota, I believe. Fair Isaac is there. Do you guys have conversations with them from time to time about, are you skewing the results of our policy in undesirable directions by somewhat constantly tightening the credit scoring criteria, which the banks then conveniently hide behind to arguably justify their new interest rate policy?
So a lot of material in that question. Just on a point of governance, the Consumer Bureau is financed from remittances, as a fraction of the remittances coming out of the Federal Reserve, and we actually do not have any direct oversight over the Consumer Bureau. That's a totally separate entity. So, but more broadly, you know, I think that on the supervision regulatory front, which is separate from the Federal Open Market Committee, regulation is by and large written at the board, by the Board of Governors, of which I'm not a member. The Board of Governors is 7 people who are appointed by the President, approved by the Senate, and confirmed by the Senate. And you know, but they have to strike a delicate balance, as you're sort of suggesting, between the risks. We don't want the financial sector to be taking on the risks that that led to the problems in 2006, 2007, 2008, and so on. On the other hand, we also want to have be able to have the kind of growth that we have. We want to have growth in the economy that finances the kind of demand that will lead to the kind of stimulus and better outcomes that we want. So those kinds of balancing acts is being, you know, they're very aware of that when they're thinking about on the regulatory front. In terms of excess reserves, so I think there's a lot of emphasis, and I just did in my speech too, about the quantities that we're buying, and you know, we talk in terms of that. Really, though, to make this clear, I'll talk about Operation Twist, which was a decision that was made in September of 2011 to sell off the short-term securities on the Fed's balance sheet and buy longer-term ones. Now, there's no excess reserves being created in there at all. Why did the Fed do that? It's because it was trying to lower long-term yields, take out interest rate risk being held by the private sector, and thereby lower long-term yields in financial markets and lead people to take on more long-term investment risk. No creation of reserves there. No creation of quantities. No creation of any of that. Our action, what we're doing through the creation of reserves is just a way to finance our purchase of long-term assets. The goal here is to push down on those yields of long-term securities. And you know, again, there's a lot of work that's been done on whether or not this is successful. The elasticities might be lower than you'd like them to be, but that, you know, that's life. But the idea that these are actually able to lower the long-term yields facing investors, making it more on the margin, more desirable for them to spend as opposed to save, I think that work, at least in my eyes, seems relatively incontrovertible.
You alluded earlier that keeping interest rates low may be problematic. Specifically, you've been accused by somebody like Bill Gross of financial repression. And how do we know if low rates, as you said, inflate asset prices because people reach for yield either in stocks or high-yield bonds, and returns are going to be more volatile? How do we know that we're not setting ourselves up for a much worse condition than if the Fed were to signal that it is stopping QE, it's going to allow rates to go up, and then all of a sudden you get people off the fence, whether they're home buyers or they're businessmen looking to invest, saying, you know what, my cost of capital is going to go up, I better invest today, I better buy the house today, and that could lead, and also having higher incomes associated with higher rates, especially as the baby boomers age, all of a sudden you get much more spending because the baby boomers are going to be spending that income, not saving it.
So again, a lot of good material in that question. I think that let me talk first about one piece of well, I'll start with your overall point, which is there are risks associated with low real interest rates. Low real interest rates introduce, I think, signs of financial market instability. That's what I talked about in my talk. And I think the Federal Reserve, the FOMC, well, I'll start with the Federal Reserve and other regulatory agencies. I think that environment of low real interest rates, I think, will put more emphasis on the need to be have very effective supervision regulation. I think it's going to expose the system to the kinds of risks that I mentioned and possibly other ones that you mentioned. That's going to put more of a premium on being very effective in our supervision and regulation. In terms of monetary policy, we have to take as given what the supervision regulation that's going on around us and think about what does that mean for interest rates. Right now, given the employment picture we have, given the inflation picture we have, I think it would be very deleterious. On net, I think you have to weigh, as I said, this probabilistic cost-benefit calculation, the certainty of throwing people out of work by raising rates, the certainty of lowering prices by raising rates, versus the potential benefit of forestalling a possible crisis. At this stage, for myself, I don't see that cost-benefit calculation is working. Now, the final part of your question was maybe raising rates will actually be stimulative. Maybe the sign is wrong in what I'm saying. You know, I hear these arguments all the time, and there's definitely at any point in time, raising rates will improve the incomes for some people, and it's going to lower incomes for others. On net, the substitution effect is really very powerful. So the income effects that you're pointing to, you know, there's definitely going to be some people who are going to have higher incomes if we raise rates. But on net, other people are going to have lower incomes, the borrowers, and on net, the substitution effect is really the powerful force. The final thing, which you said so many interesting things, the final piece on this is on the uncertainty part. This is something I actually worry about a lot, which is, you know, when interest rates are really low, it really leads people, there is a force, it's called the option value of waiting to invest, that there's a gain to just waiting to see what's going to happen. That's always true with investment. You can invest now, you can invest later. What's the gain of investing later? You're going to find out what's going to happen. You'll get more information. The cost is you're losing income over that time frame that you could put in the bank. Right now, that trade-off looks very beneficial to wait. It's absolutely true that that option value of waiting to invest is very high right now. Nonetheless, when you put this in, you do the calculations out, and they're not that complicated, the direct effect of saying to people, look, we're keeping your interest rates low, you should be investing as opposed to saving in the marketplace. That direct substitution effect, again, outweighs the effects of uncertainty.